Hey, what is up, guys? My name is Sobi Kenobi, and this is Gowinvest 101. Today, we are talking about the disaster that occurred yesterday with my Neo play. I was trying to do a Fibonacci double down on yesterday where it just went down, 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 and down. It didn't seem to come back up, and then I threw a kitchen sink at it by basically going into the call options, as I mentioned last time. And I told you, like, this is something you guys shouldn't do. Really, you should look for validation and have sold out. I should have sold out right here. Even if I was just in the shares, I would have made a minimal loss, if any, on my Robinhood. Yet now I am currently at only $115 on my one. I could have easily exited right here, maybe a little loss of a few hundred, like $20 or something like that, 10, $20. But instead, I threw the kitchen sink at it and basically put my chips on a roulette table. It would have either gone up today or down today, and it turns out like market open looked like it was kind of going in my way, and as soon as the market opened, just dropped until I looked for the possible exit point right here, and that possible exit point landed me currently on this account at $353. So we basically made a net loss this week of $149, and my Robinhood is down a considerable amount. Luckily, it's we got out and we still are in the game, but it is a huge setback, and this is the life of a trader. But what I want to talk about today, lesson number 10, macroeconomic factors, and these are things are really the games that people play in the stock market. So you have to know these kind of common things that go on in the stock market so that you are better prepared for the type of games people play. Let's go into it, and I want to minimize my screen right here. So I'm putting my screen down here. We're opening up Photoshop. So lesson number 10. Wait. Okay, I gotta take out my phone. Putting that up here. Lesson 10. Oh, the games people play. And I wanted to let you know this because it'll occur a lot of times while trading, and you'll hear this maybe from ZipTrader or from other things. Is there's something called a pre-anticipatory run up. And in fact, this is such an industry-wide standard. Like, I'm talking about these as typical run-of-the-mill, situations that the stock market finds itself in, mainly because you see it happen way too often. And in fact, people already know that it happens often. So there's something called buy the rumor, sell the news. So when you see, like, let's talk back about doggy coin price. I'm going back here to the coin market cap. We're looking back for the 3-month period, maybe, and then right around here, like, I don't know why it went to the zoomed in view. I want to go to the 3-month view. Let's get that. Let's isolate that. So it was going up to 71 cents right as soon as the story broke that Elon was going to go on to Saturday Night Live. Everyone had the opinion that Dogecoin would go up to $1, so that kind of just drove the price from 50 cents all the way up to 71 cents. Now that's a crazy high, but what could happen on a pre-anticipatory run is that everyone's hyped for the news, and usually the hype is greater than what can occur in reality. You see this with a lot of salespeople and things like that. Whenever they sell you something, they sell it to you on hype. They want you to feel like, okay, this is a once in a lifetime opportunity. Get in on the ground floor. So right as the hype train is going up, it comes up right here until the news breaks. Now, if it's extremely, extremely good news, which is a very rarity, it'll continue to move up. But if it's not as good as the hype was, then it'll start to move down. You'll see this happen a lot of times. One, in terms of Warcraft 3 remake. And then a ton of people were criticizing it. There's also the Cyberpunk game. And you'll see this happen a lot in terms of the stock market too, where hype was crazy high, maybe even Star Citizen. So a lot of times the hype does not match reality. So people are all hyped about it. It could be this, it could be that, could, change the world. But really what happens is it kind of just dies down. And people in the stock market know this. A lot of hedge funds know this. So they buy in right over here. And then as soon as the news comes out, they switch into puts, or really just shorts. So they short the market as soon as the news occurs because they know that there's nothing holding that value up. Everyone's exhausted. Everyone's put in all their money in on this rise. No one has the stamina to hold up when it falls. So this is a great shorting opportunity. So that was number one, pre-anticipatory run-up. Okay, you'll hear this happen a lot. It happens in terms of FDA news for a biotech company. It happens on earnings reports. It happens on currently as well, like delivery reports. It could be like news events. And these news events could be like Battery Day on NIO or on Tesla and things like that. So you'll see these dates kind of mentioned, and then like prior to the date, it just keeps running up. But then right after it, it'll keep selling off. And that's something you can kind of bet on. And I say kind of because there are these occasions that it does way better than anticipated and just continues to run up on pure hype. But NIO is not that. The other thing to do, like with a stock, and I want to bring up, let me just bring up NIO stock here on Webull. Trade, let's look up NIO. Okay, so with NIO, you can always, to check to see if you are at a really high, we could have moved, instead of being over here, to the monthlies. And you can easily see here that it popped above the high Bollinger Band on the 30th. So a, it was bound to go down from there, you know. And in fact, this comes to the second axiom to use, which is when in doubt, zoom out. So if you are thinking that, let me see if this is a good play for not only the day, but for the month, you look at the month-long chart, and the month-long chart is doing pretty well. If I can zoom out here, the month-long chart did held above mid-Bollinger Band right from 24th. So you could have really held over here for a good period of time. It was just bound to come down from there. It could not sustain that exact high, but you can zoom out and you could have easily seen that we were headed for potentially a down day. After a bunch of good days, there's bound to be a bad day. So in fact, I did the research. And there are about 9% of bad days. And the reason being is because stocks always go up. There's an anticipation that the stock price will go up, but okay. But occasionally it does like somewhat of a pullback, and you'll have about 9% of these days be bad days. And I'm saying 9% because I did the statistics, and I'll show you that more on the scripting side, but that's what you can anticipate. The other thing to do to make sure you are not catching a bad day is look up SPY. SPY is the index of the stock market. I mean, totally, it's been just linearly rising. And that is usually unsustainable. There are good days in SPY, there are bad days in SPY. SPY gives an annualized return about 8% a year. You know, so you're looking at this potentially as a hedge against inflation, but you look at the SPY ETF and you see that there hasn't been enough bad days to counter the good days. It looks like it's been holding above mid-Bollinger Band for the days, holding above upper Bollinger Band for the days, so it could be due for a pullback potentially soon. And you've seen regular pullbacks happen, you know, certain times. Generally, the trend is up, but occasionally you'll have pullbacks. So that's the second thing is make sure to check SPY. Two, so first thing to know, game, is pre-anticipatory run up. The second thing is market direction. And you check that out through SPY, through DGI, which is the Dow Jones Industrial. Let's check that out. DJI. Dow. I think it's QQQ. Dow Industrial. So you look up the Dow Industrial and NASDAQ. I think it was QQQ. I'm not sure. But basically, you look these up and you see how well they're doing, and you can see how the market's doing. Again, I also talked about SVXY and UVXY as being extra sensitive to good market days and bad market days, so you can look that up too. Is it worth playing options on this if you say, hey, this is continually a rise, so why don't I just put calls on this for the long term and ride that rise? But the idea here is it's already priced in. People have already done the calculations. Those options for the calls will be way more expensive than the options for the puts, and on the reason that only 9% of the days are bad. So two, you have to make sure of market direction, and that's very important. Right, so I want to talk about number three, which is long holidays. And long holidays, like right now, we have the July 4th weekend. And generally, these long weekends mean a shorter work week next week. Shorter next week. And what that does is it kind of gets people a little scared. They start to pull money out. So here's the idea. Basically, every week you have Monday through Wednesday, which could be generally up. Then you have Thursday and Friday, which are generally down. And the reason being is these are 2 degrees out for people who are smart. And the reason being is people are taking profits. So people on Monday through Wednesday have a very high conviction on the stock market. They're like, let me grow some money today. I want to do some work. I'm pumped up. I had some break on the weekend. I'm ready to join this market. So they pump it up Monday to Wednesday. Thursday to Friday, generally downtrending because everyone's tired. Everyone's already pumped it up and they're taking money out. So Friday, they would absolutely be taking money out or be repositioning money. Thursday is the pre-run up. It's the second degree out. And the reason being is that people know that people will be pulling out on Friday. So to preempt them, they pull out on Thursday. So you have long weekends that are deprecating factors. You have Thursday and Friday just generally deprecating factors. So what you want to do is tally up all the deprecating factors and you want to tally up all the appreciating factors. So the appreciating factors is it is already too low. And it was good news. The deprecating factors is pre-anticipatory runoff. Run up really, and then you also have market like month-long rise needed retraction. And then lastly, the thing is a 3-day weekend. And had I done this analysis prior to getting my emotions involved, it would have made clear sense to not go for options calls. I want to quickly talk about number 4, which is stock splits, mergers, and share offerings. Okay, stock splits. Stock splits are something that the company can decide on to make, like, say, 5 shares into 1 share. And it's reverse. They have reverse splits and they have stock splits. So a stock reverse split would be that they're changing 5 shares to 1 shares. Usually stock splits are good things. Stocks reverse splits are bad things. So say something was going down to below $1. and they're at risk of defunding or not defunding, but basically getting downgraded. So what they do is like, hey, they would not be featured on the NASDAQ if their stock holds below $1. So what they do is they take 5 shares. So say they're trading at 20 cents. They're going to turn 5 of these into one real share. And remember how I told you price matters? One Bitcoin currently is at, I'm going to say about 40K. That's more money than someone has in their bank account. So they can buy a 0.001 of a Bitcoin, maybe. Ethereum, they could probably buy 1 ETH. But whereas Dogecoin, they can probably buy 3,000 Dogecoin. So it makes more sense. Like these numbers, higher numbers make sense. Lower numbers make less sense. I mean, just generally through a period to somebody's brain. So you have China here devaluing its currency because like people are uh, kind of focused on small amounts. They're focused on, whole numbers. If you start talking about thousands, tens of thousands, hundreds of thousands, it starts to get confusing. Okay? So what they realize is the perception of the money matters. So what a company can do is they can issue some low valued shares. And then once they put up some good news, they pump their shares up to a certain price, and if they really have a problem, then they'll do this type of stock reverse split. Now, stock split occurred with Tesla when they hit like about $2,000 and they wanted to bring it down to like $500 a share. So they basically put 1 and they turned it into 4, a 1 to 4 or 1 to 5 stock split. Now let's talk about mergers for a second. There is the Sprint and T-Mobile merger that occurred a while ago. But basically Sprint kind of traded sideways for a while. T-Mobile has its own value for the shares, which are about $75, and they were doing like a 10-to-1 stock split. So this was trading around $4. So doing the math, this should be worth 7.5, but there were some underlying factors into it. So I don't know, it was trading sideways, but once this was approved by the courts, this thing jumped to 7.5. And that's something that you have to see is which is the acquiring company. I think Meta Materials got like Torchlight, TRCH, one of the things that we traded on last time for our, trying to show the Bollinger Band plays, came into contact with Meta Materials, Meta Metals or something like that, I think. And this caused the price to go down because Meta Metals, even though Meta Metals stock went up, it wasn't really publicly traded or had a lot of volume. But once Torchlight was confirmed as merged, it actually caused the price to go down. So even though the run-up pushed it to some highs, the merger pushed it down because no one knew the price of MetaMetals. It was just one of those, side stocks, maybe OTCs or something like that, maybe not traded on NASDAQ. But once they did the merger, now they changed the NASDAQ symbol to Meta, and what you saw was a huge decline because Meta shares were oversaturated. There were too many in the market. Now, the last thing I want to talk to you is really the most significant. I mean, especially if you play pennies. So this is very important for pennies, because what a company will do is they'll do an 8K Edgar filing. Edgar is the SEC system for when you file any news. So they'll say that they did something like cure cancer, or some, like, one of their things got approved, and some very hypey news. And then what happens after that hypey news is that the stock price will shoot up, because people think, okay, this thing is coming out. They don't know what the value is. But what happens is, before they had this in place, they already had an idea of profiting from the shares. So usually a company has issued out their shares. Let's just draw a little building there. They've issued out shares. The people bought those shares and give capital. It's free money. Free money. So say they own 51% of the company. They gave 49% out as shares. These 49 were bought by people, and they were given capital. Okay? Whatever their shares are worth. Now they've done something good. The stock price shoots up. How do they profit from the higher stock price? So say it's like an FDA approval. Okay, so how do they profit from the high stock? Is, guess what? They own the majority. So they can just print shares. Just saturate the market. What this printing shares does, and usually they have a hedge fund planned to buy up the shares at a low price. So say it was trading at 20 cents and it's moving up. Now people don't know what it's worth, but when they hedge fund agreed to buy it because of the news, they said we'll buy it for 25 cents. Okay, people don't know that this agreement has come, because that will happen in another filing, another 8K filing. So people don't know it. It just pushes it up to say 0.7 cents. Then like 70 cents, really. 20 cents and 70 cents, not 0.2 and 0.7, but 70 cents. Then what happens is then they announce it. And all of this should have been in the pipelines beforehand. But when they announce it, share value will go all the way back down to the 25 cents, because over here it was just speculation. What is a share worth? Because of the news. But when the company says that they sold 2 or 3 million shares at 25 cents each, then it's given a value. It's already told you that this is the value of the share. So everyone who realizes they've overpaid tries to get out like there's a fire in the house. Okay, so you got to just get out before the fire burns up the whole place. Okay, so that's what a share offering is. Those are stock mergers and stock reverse splits. You have to be very wary of these things. These are things that can really impact your value, both in the positive direction or in the negative direction. Generally, these are negatives. Reverse splits are negatives. Mergers in the bad direction would be negative, and share offerings are also on the negative side. Even if they do an at-the-money share offering, you still have the pre-anticipatory runoff that they're going to do. They're going to do a dilution. each share is basically worth less of the company. So it's definitely going to drive the price down. So these are the games that people play. I want you to be wary of them. And that's our class for today. If you liked the class, you learned something from it, please like and subscribe. But that is the end of Go Invest 101. From next week, we're going to be starting Go Invest 201, which is options trading.